I just backtested another month of Virgin Wick Theory trades, bringing my backtesting data to a total of 160 trades for a net total of plus 66R over December 2025 and November 2025 on gold and NQ. But the data is showing very clearly that one specific entry model and one specific kill zone is the clear edge if you want to maximize your profits. But first, here's a super quick summary of exactly what the Virgin Wick theory is and what I'm backtesting. So first we need to understand what a Virgin Wick is. So Virgin Wick is essentially any wick that has not been touched before. So if you look at this one, if you draw a line all the way to the right, hasn't been touched. This one, that's virgin, hasn't been touched. This one, all the way to the right, nothing there, that's virgin. So essentially any exposed wicks, right? Pretty straightforward. So we want to look for a candle, a Chad candle, to close through any virgin wicks. We then mark off that virgin wick level as a POI, a point of interest. If the Chad candle is bullish, then we create a bullish POI. And then in the next hour candle, we want to drop down to the 1 minute and catch a move down to the point of interest and then back up for a long. So you'll drop down to the 1 minute and this is what it would look like on the 1 minute. Either we go all the way down, we close below, and then we get an engulfing candle above the candle that closed below the POI, and then you would long there. Or we get a inverse fair value gap entry model and we close back above and then we enter the long there. That's a super quick summary of it. I'll go through one example really quickly. So, all right, let's say the next candle opens there. Then we would mark off our points of interest. So we've got this version that I just got close through, this one, and this one, this one, this one. Oops. It's actually quite a lot. So when you have this many, you just mark them all off and they all become points of interest. Then mark off our 8 p.m. vertical line because that's where we'd start looking for entries. So we do have a close above a point of interest, but no entry model yet. We continue to close above points of interest, so we're still looking for our entry model. Nothing yet, nothing yet. Okay, boom. We have an inverse fair value gap here, but we haven't actually closed below the point of interest, so we are still looking for any close below and we would enter because we have a confirmed inverse fair value gap. So boom, we finally closed below a point of interest that presented an inverse fair value gap, so this top one. So you would enter there, you put your stop at that high, target 2R. So you can target the lowest liquidity, but I only go for 2R max. So that's what the trade would look like. And boom, there you go. Eventually goes to TP. Nice, nice and easy. So that's the entry model in a nutshell. And here's a quick overview of the trading Bible, which is just the rules around how I use this strategy. So I'm currently using it on NQ and GC, but I'm actually going to start looking into silver as well. I'm going to start backtesting that and seeing how that goes. Trading times are currently 8 to 12 for Asia, 2 to 5 for London, 8 to 11 for New York. Yeah, I'll go over into which sessions are most profitable once we go over the data. But yeah, 1 hour to 1 minute time frame alignment. I'm risking roughly 200 per trade, which is 10% of 50K prop firm accounts that I have. TP at the most obvious swing point or draw on liquidity. Must be an obvious draw on liquidity. I will not target empty space, so there must be a target. 1.5R minimum, or I will not take it, and I will cap my profits at 2R max. Stop loss will be at the most recent swing point, or if it's too far away, I'll put it just below the entry candle. the trade will either hit stop loss or take profits. I will not take any partials. I will not take an early TP. I will not move my stop to break even. It is one result or the other. I journal every trade, follow the strategy like a robot, take every trade that is presented. The point of interest is only valid for the next hour. I will restart the process after the hour ends. I'll get out at the end of every hour regardless of where the trade is at. No entries in the last 10 minutes of an hour. If I get stopped out, I can re-enter again on the same point of interest in that same hour, as long as there is another stop hunt. And yeah, if there are multiple POIs, you can look for your model on any of them. But the one created from the most recent candle is the strongest because the market wants to close any imbalances. And if that wick was to be left untouched, then that would create a fair value gap, which is an imbalance in the market. And essentially this strategy is just betting that the market will balance price action and not leave any fair value gaps instead of being imbalanced. Strategy we already went over, but this is just the text version of it. Wait for a candle to close above virgin wicks. This is for a bullish example. Those wick levels then become bullish POIs. Then we drop to the 1 minute to look for the candle to close below the POI. Then we look for an entry model, either an engulfing candle or an inverse fair value gap. And then limit order at the close of the confirmation candle, stop loss at the most recent low, and TP at liquidity or 2R. Simple. So that's the strategy in a nutshell. I'll go over the backtesting now. So I won't go over the whole backtesting process because I just did a 1 hour video on that a few days ago. So if you want to see how I go about backtesting and how I got the results, especially for December, then you can check that out. But this would just be an analysis of the results. So from the last video, we had 73 trades in December with a 58.9% win rate for a total of 45R with an expected R of 0.62. I just did November yesterday and we had some more trades. November didn't do as well. But that brings our grand total to 81 wins, 79 losses, 50% win rate, 66R all up, so still positive, and an expected R of 0.41R. So there's a few. I'll just do a super quick summary of the results in case you don't give a fuck about the numbers, you just want the key takeaways. Overall, clearly a positive edge. Every trade returns on average 0.41R in the long term. So the model is definitely profitable, but we can make it better. So the most important thing is the entry model. What I discovered is that an inverse fair value gap entry is significantly better than just an engulfing entry. Like 0.83 expected R versus a negative expectancy on engulfing candles. So from this, I'm going to completely drop engulfing candle entries, and I will only take this model if there is an inverse fair value gap present. Otherwise, I'm not touching it. And then with gold and NQ, both are profitable, but gold seems to take the edge slightly. But yeah, you can still trade both. Both are good. Sessions, Asia is the clear winner. Best edge by far, 0.51R expectancy versus 0.37 or 0.36. But again, both New York and London are positive, so you can still trade all sessions if you don't mind the extra screen time. But yeah, clearly the best combination is trading inverse fair value gap entry models with gold during Asia for a whopping 1.15R expectancy. If you could only pick one session, one asset, that would be it. And yeah, it makes sense. But yeah, if you want to maximize profits, so for me, for example, I'm currently living in Asia, so I can actually trade all 3 sessions. So all 3 are profitable as long as you only use an inverse fair value gap entry. And you can trade both NQ and gold for an expected 0.7 to 0.8R expectancy per trade. But yeah, if you only wanted to minimize screen time, get the most highest expectancy, then just trade Asia and only trade gold. But yeah, those are the main takeaways. If you want to go further into it, let's have a look. Yeah, so if we break it down by entry model and asset, we can see clearly just engulfing trades just did not work out. So it was 19 wins, 36 losses for 34% win rate. If we look at inverse fair value gap entries, 28 wins, 16 losses, 0.79 expected R, pretty similar on gold and NQ. And then when there is both an engulfing candle and an inverse fair value gap present, we had 34 wins, 27 losses, total of 36 R, 0.6 R expectancy, so still pretty good. So yeah, my conclusion from this is inverse fair value gap good, engulfing candle is bad. Like there needs to be an inverse fair value gap in the entry or it's just not worth taking it. Here is the breakdown of sessions. So we've got clearly the winner is Asia. Asia is very good on both gold and NQ with 0.5 R expectancy. What do we have here? Yeah, London gold is not that good. London NQ is decent. NQ gold, surprisingly pretty good. But trading NQ during New York session seems very low R, 0.2 R. Still positive, but not the greatest. So my main takeaway from this is Asia is king. NQ and London is still okay, but lower expectancy than Asia. And then here's a direct comparison between gold and NQ. We can see both are profitable, but clearly gold is the winner with a 53% win rate, 0.48 expected R. NQ with a 47% win rate and a 0.33% R. So those are my main takeaways. This is just like a more nerdy breakdown if you want to look at every possible combination of asset, session, and entry model. Yeah, like I said, gold plus Asia plus inverse fair value gap entry is clearly the winner. Or gold. Oh, this one was high, but low sample size. Gold, London with inverse fair value gap and engulfing candle was very high. But yeah, that's a lot to go through. But in short, I think we have a decent enough sample size to say that model is definitely profitable, just can be even better if you only use inverse fair value gap entries, and especially if you trade gold, especially if you trade during Asia. I will still add maybe 1 or 2 months to this just to make it more robust and have a real clear idea of what the stats are showing. But I think at this point it's pretty clear to me what the edge is. And to finish this video off, I'll just go over the 2 trades I had yesterday. It was a break-even day for me. I had a nice 2R win on gold during Asia, and then a loss during NQ during London, which in hindsight should have actually been a win, but I executed poorly. But I'll go over that and you'll see why. But we'll go over this gold trade first. This is the same example that I used at the start of the video, but it was such a good trade. I mean, I had to use it, so I'll go over it again. So we had this 7 o'clock candle close, very bearish candle, creating a bunch of POIs. So we had this one, bang, bang, bang. So we'll mark these off. And then drop down to the 1 minute. Wait for price to close above any of them and then present an entry model from that same POI it closed above. So it has closed above a bunch, but no entry model yet. and then bang, there is your inverse fair value gap. So as soon as we close above this, sorry, below this one, that is your sign to enter. So this is when I entered. I believe my entry was actually here because the next candle came up a bit. Yeah, there. So sometimes your entry is not going to be exactly there because you might get lucky and the next candle might actually go towards your stop loss a bit. So you get a bit of a better RR or just a safer trade than if you were to enter there. So I entered there, put my stop at that high and then targeted to nice and easy. It's a beautiful trade. And I mean, we can't say we're surprised, right? After looking at the stats, gold during Asia with an inverse fair value gap entry just seems to be money right now. So can't say I'm surprised that we had such a clean trade during Asia. That was the win for the day. And then I'll just quickly go over the loss I had as well. Okay, so here was NQ during London. So let's go here. We had this massive bearish candle at 3 a.m. creating a bunch of POIs there. This one, yeah, this one. That was it. So these are your bearish POIs, and then we're going to go down to the 1 minute for the 4 a.m. candle. Okay, so nothing yet. Okay, yeah, so like I said before, we're only playing inverse fair value gaps now. So there's one there, there's probably a few more there. Yeah, there's a bunch. And so since we already closed above this POI, as long as we get any close below it, we have the presence of inverse fair value gaps, so that would be our signal to enter. Okay, so here's where I entered, right? So this candle here, the 436 candle, is our confirmation that the model is in play because we closed below the POI and we have inverse fair value gaps present. Let me go back here actually. Okay, so bang, candle closes. What I wanted to do was set a short entry there, stop just above this candle because like I said way earlier, we don't want to put our stop all the way there because if the stop's too far, the risk reward is just not going to be there. So I'll go just above the entry candle and then you can target 2R, nice and easy. But I didn't have time, and so this next candle spawned and then I got a bit flustered and I just market entered. So I ended up marketing in somewhere like there. And so since I didn't get the ideal entry that I wanted around there, I was like, okay, let me get a bit greedy on my stop loss and just put it like there. Because my entry wasn't as good. There's still liquidity to target, so I'm like, okay, that should be okay. And then as we play it out, boom, I ended up getting stopped out by just a few ticks. And then price ended up delivering anyways. So yeah, if I just stuck to leaving my limit order here, putting my stop just above that candle there, still targeting 2R, I would have ended up getting entered in there. I wouldn't have got stopped out and I would have hit TP in a few candles. But yeah, that's okay. We move on. We learn from the lesson. That's why we journal. That's why we reflect on our trades. And I now have a rule to just always limit order at confirmation, at the close of the confirmation candle, so right there, instead of chasing market orders because it's just going to mess everything up. But yeah, those were the two trades for the day, break even, and yeah, hope you enjoyed that.